Hello, welcome back to the Risk on Investor. In today's video, we're going to be looking at my Ether investment thesis. If you watch my portfolio video, which is the last one on the playlist, you'll see that I hold some Ether, which is a cryptocurrency. I just want to go over why I've invested in that, a few price predictions, and just a bit of discussion around the ecosystem. So just a quick disclaimer, I do own ETH, just in case you think there's any bias in the video. And the information here is presented for entertainment only. It's not financial advice. So I'm going to cover just a very quick what is Ethereum as a network, the Ethereum business model as I see it, a bit of an idea for future demand for Ether based on its current usage, the Ethereum unique selling point, other investment narratives, and then at the end I'll finish with a bit of a price thesis and my predictions. So what is the Ethereum network? So I'm really just going to skim over this, because if you're watching this video, you probably have a bit of an idea, but it's a distributed ledger at the end of the day. So different nodes, so these are sort of the computers that are shown in this diagram at the bottom, all have copies of the blockchain, which is on the layer above. And on that blockchain, you can run contracts, you can build tokens, you can write code to do whatever you can dream up, basically. So the Ethereum business model effectively is the Ethereum network sells block space to people who want to buy it. So people might want to buy the block space for all manner of reasons. They might want to record a transaction. They might want to execute a bit of smart contract code. And so basically there is a demand for that block space. So that's the users at the bottom there in this diagram. And then you've got the computers at the top, which run the network. So people pay Ether to put information into the blockchain. And there's a reward then that goes to those who are running the network. We'll cover a bit more of that reward thesis because I think it's important to understand. The other thing that I think is really useful to understand is what is a block. So it sounds simple when you think blockchain, oh, it's just some discrete items that contain information. But there's a few key bits that you need to understand for the Ethereum blockchain. So blocks run on something called gas. Gas is just a way that the Ethereum network measures the computational power needed to execute a block. So for example, a simple transaction is just recording, moving a token. It doesn't have to be Ether. It could be anything built on top of Ethereum from one address to another. There's very little computational power required for that, so it would have quite a low gas requirement. However, if you're executing a smart contract where maybe you're swapping one token for another, but you have to swap, say, Ether to another token to get to your final token desired, there's quite a few layers of information in there that are built up. And so that would use a lot more gas. Now, every block on Ethereum has a target to use 15 million gas. So that's just a target. There is a limit. The limit is 30 million. So that means no single block on the Ethereum network will use more than 30 million gas. Blocks produced every 12 seconds under the proof of stake model, or maybe more accurately, I should say there's a slot for a block every 12 seconds, but a block doesn't necessarily have to appear every 12 seconds. Users then pay a fee to get their information into the block, and this is part of the sort of key mechanism that underpins Ethereum. So there's a base fee and there's a tip fee. The base fee is defined by the network, and the tip fee is defined by the user. I'm going to go into that base fee in a little bit more detail because I think it's important to understand for the investment thesis. And then finally, just on that base fee, the base fee is actually burnt, so that means it's taken out of circulation, which can effectively act as a bit of a price boost to everyone who owns Ether. So here's just a really quick example. So this is taken from a website known as Etherscan, which is quite a nice, easy format way to see what's going on the Ethereum blockchain. So I've taken just a screenshot here of a block, just a random block, and just highlighted a couple of bits that relate to what we've talked about so far. So you'll see around the middle of this page, there's the fee rewards. So you can see there's the total fee there. That's that 0.47-ish ETH. That consists of both the base fee and the tip fee. The base fee made up the majority of that in this block, and it's the base fee that's burnt. So you'll see then that there's only a little bit of that total fee that is then paid to the validator. The rest of it was burnt. And down the bottom here, you can see that the the block here was actually smaller than the target of 15 million gas. So that means the next base fee that's calculated by the network for the next block will be lower than it was for this block. So just to help demonstrate how this works as a business model for the Ethereum network, I've just prepared a chart here and a couple of tables that just show how the fees work for Ethereum. One thing I will just point out is there's a black line down the middle of the chart. That's the date that the proof of work to proof of stake swap happened. This chart goes back all the way to the beginning of the fee burn economic model, because it's only been in Ethereum since mid-2021. So it hasn't been there since the start of the network. So I've disregarded the data from before that. So the black line, the or sort of faded black line, the grey line, is the price of Ether. That's important to know in the context because the fees that Ethereum collects are paid in Ether. So you'll see the red line is the total transaction fees, and you'll see when that spikes with the price, it doesn't necessarily mean that the demand is particularly higher necessarily. It can also mean that that the price of Ether has gone up. So when the blockchain is charging fees in Ether, it becomes more when you convert that back to a USD or a Great British Pound. On the right here, you'll see that if we extrapolate out some numbers, so I've just taken average fees on given periods of time and then extrapolated that out to what that would give Ethereum as a network as revenue. And you can see there it varies anywhere from $500 million to 83 billion, depending on which timeframes you take. So that was our whistle-stop tour on the introduction to Ethereum and its business model. Just want to have a quick look at future demand for Ether. Ether as the asset on the Ethereum network. So I've overlaid a chart here, which I've just color-coded different market cycles. So those of you who've been in crypto a little while will know that there's been these distinct market cycles where you get a period of depressed growth, then you'll suddenly get this takeoff period where you'll get a lot of hype and speculation, where you get massive increases in prices, and then you'll get a big crash down back down to a new lower level, and then the cycle seems to repeat itself. It appears to coincide with Bitcoin halvings, also coincides with macro events such as US election cycles. Some people have argued it coincides with debt refinancing cycles as well. But whatever the reason, there seems to have been these cycles that have played out in cryptocurrency. So again, I've just put in a black line indicating when EIP 1559, which is what introduced this fee burning mechanism, was introduced. It was brought in to try and regulate gas fees and make it more predictable. And you'll see here there are much larger spikes to the left of that black line when we look at the red chart that I've put together that shows that there were much higher spikes in the fees, whereas it's become a lot more predictable since. I think this shows a maturing of the Ethereum network, so more stable fees are going to make it easier to use and more predictable to use as the end user. So it'll be interesting to see if we do get another one of these market cycles where we get a huge speculation hype bubble, whether we'll get an explosion in fees again, or whether they'll stay relatively muted. It's a double-edged sword for the Ethereum network, because obviously transaction fees in this business model image that we've got, higher transaction fees generally equals more profit for the Ethereum network, but also higher transaction fees will drive users away because of the expense of the blockchain. When we look at future demand for Ether, obviously we can't predict what the future demand for Ether will be, but we can look at different indicators. One of the key ones that I like is the developers that are building on the network. So when you get more developers, you get more applications, you've got more use cases that people might want to use built on the blockchain. And you'll see that the Ethereum network tends to have a spike, a bit of a plateau, a spike, a bit of a plateau. And we're in one of those plateau stages at the moment. So you'll see here at the end of the chart, there's a bit of a bump and then a depression again, where we're only up about 5% across that range. And again, if you look towards the middle of the chart, you'll see a depressed period there, which was the last time we had one of these sort of flat ranging markets. Just to put that into context as well, this is some of the sort of common popular blockchains, and you'll see that way out there on the right-hand side of the chart is Ethereum, which has way more developers than the next largest blockchain. even far beating out things like Bitcoin, which is probably the best known of the blockchains. You'll also see that not only is Ethereum the biggest by developers, but it's still rapidly growing. So it was the biggest ecosystem in 2018, but between 2018 and 2022, it still grew massively. So you'll see it added thousands of new developers in that time period. And as we've just said, new developers mean new applications, which mean new reasons why people want to use the blockchain, which creates more demand for Ether, the asset. Another thing I just want to touch on was back in 2021, the Ethereum network actually settled more value than Visa did. So you can see there that kind of purple line, and it's the Ethereum network settlements. The blue is Visa and the orange is Bitcoin. So you see that Ethereum far outstripped Bitcoin and even nudged out Visa for the total settlements. Now, Visa had more transactions, but just lower value transactions, and that just shows because Visa's more of a retail chain. Your bank card might run on Visa. So if you're going out and you're spending 20 quid here, 10 quid there, you need a lot more transactions to add up to the big numbers, whereas Ethereum tends to do fewer transactions with higher transaction values. Ethereum and the Ethereum ecosystem are also the big boys in terms of value locked on the chains. So this measures the value in decentralized finance applications, and you'll see that Ethereum dominates with more than half the market share. But not only that, I've just highlighted some of the other chains that are in the Ethereum ecosystem or scaling Ethereum. As you'll see when you include those, the Ethereum network takes up a huge percentage of the total value locked across the cryptocurrency world. This chart also shows the importance of Ether as an asset itself. So you'll see here this middle band I've highlighted between two black lines. That's the demand for Ether as the asset as collateral in decentralized finance. And you'll see it has more than a 50% market share. And when we look at the legend at the bottom as well, you'll see a lot of the rest of the market share actually comes from stable coins, which just shows that the Ether as an asset itself is valued, rather than, say, using a wrapped Bitcoin or other assets in centralized finance. I've just taken a quick snapshot as well of some of the fees generated by top blockchains, and you'll see that Ethereum absolutely dominates this list. But what I've also just flagged up here is other applications and chains that are part of the Ethereum ecosystem. So the ones with the pinky highlights in the background are decentralized applications built on top of Ethereum. And I've also highlighted Arbitrum One and Optimism, which are both scaling solutions for Ethereum itself, so a part of the system. So you'll see on the top 10 list, only two of the chains, so Bitcoin and BNB, aren't part of Ethereum or a scaling solution for Ethereum. So in terms of the financial revenue for blockchains, the Ethereum ecosystem absolutely dominates the cryptocurrency world. And just to put that into perspective with a bit of a visual picture as well, you'll see here again in the blue, Ethereum's share of revenue among top blockchains just absolutely dominates the market. So Ethereum itself actually only has, because of that gas limit on blocks, a certain amount of computational power that it can sell. And so to expand the business, Ethereum needs scaling solutions. So the way Ethereum is scaling is it's having what are known as layer twos. So that's Optimism, Arbitrum. There are a host of other ones as well. And they process transactions off the Ethereum chain and then just post the results back to Ethereum. So that way your transaction gets settled onto Ethereum, so that there is a record of the transfer of the value, but all the computational power that's required for that transaction to be undertaken is happening off-chain. So that means it can be cheaper to use the layer twos because they're not having to spend fees for the computational power of the layer one of Ethereum. And so the blue line on this chart shows the Ethereum mainnet, and you can see that's pretty much flat in terms of the number of transactions. But this kind of reddy orangey line in the background that you can just see starting to explode out is the scaling factor by these layer twos. So they're processing multiples of the main Ethereum chain themselves off of Ethereum and then posting that data back to Ethereum. Another chart that I find quite a good one to look at is the unique active addresses on Ethereum in a given day. And over the last 4 years, that's pretty much doubled. So that's an impressive growth rate for Ethereum as a network, and I expect to see that continue as we go through into the coming years. Just to highlight that it's not necessarily Ether as well that drives all the value. Most of the value comes from the applications that are built on top of Ethereum. So this is a really good example. This is exchanges. And so there are a number of centralized exchanges that you might know about. So for example, Coinbase is a publicly listed company in the US. We've got FTX in the really light blue, which I'm sure you're well aware of what happened to, and you'll see why that collapses to zero very early on in the chart. But I do want to draw your attention to the bottom section, which is this pinky section. And that's an application called Uniswap. Uniswap is a decentralized swap exchange built on top of Ethereum. So it's just selection pieces of code that can be executed by anyone using the Ethereum network. You can see that Uniswap is holding its own against some of these huge funded institutions. Coinbase itself is a $20 billion company by market capitalization, and Uniswap is exceeding Coinbase some days in terms of transactions and swaps. I would just caveat this chart by just saying that Binance isn't included. So Binance is the big daddy of the crypto exchanges and would completely dominate this chart just because of its size. So we've seen now that Ethereum dominates the cryptocurrency landscape in terms of the fees generated. It has loads of users. It's scaling up. But its fees are relatively high compared to pretty much every other blockchain out there. So there must be selling points, reasons why people want to use Ethereum over other chains. So I'm just going to go over some of the decentralization aspects of Ethereum that I think are what gives its block space this pristine demand by users. So you'll see this chart here. In the green, we've got a line that's just continuously going up at the moment. So that's the active validator counts on the network. So a validator is a collection of Ether. So it's 32 Ether. And people post their Ether to the Ethereum network and put that Ether at risk. So if they validate something incorrectly, they lose part of that Ether. But if they validate something correctly, they get a reward in Ether, which is part of that tip fee in that base and tip fee example that we looked at earlier. So if this line was just going up at 3 or 4% per year, then we'd expect that just to be the rewards that validators are collecting being reinvested. But the graph is going up much, much faster than that 3 or 4%, which is the approximate staking rewards that a validator will get, as that indicates new validators are being added to the network at a rapid rate. And so the more validators that are added to the network, the potential that you have for more or a wider variety of actors supporting the network, and that's good for decentralization. We'll see here that Ethereum nodes also run a wide diversity of clients. That means there's different software running different nodes behind the scenes. And that's good because if you had a bug in a piece of software in your node system that got activated by an update to the Ethereum network, if everyone was running the same client, the entire network would go down. Whereas here you can see there's a lot of redundancy. We could lose a client, and even if it was the biggest client, which is Geth or Go Ethereum, you'd still see that more than half the network would still remain up, even if we lost the biggest client. The right-hand pie chart just shows the distribution of the nodes as well, where they're running. And it is dominated by Amazon Web Services at the moment. But again, you can see that if Amazon Web Services had an issue, the Ethereum network would still be running because around half the nodes would still be running on other service providers. You may recall a while back, Netflix had problems where there was an issue with Amazon Web Services servers, and Netflix went down for a while because of all their systems were hosted and running on AWS. So with Ethereum, that wouldn't have been a problem when AWS went down. You'll also see that the Ethereum nodes are well spread geographically. Whilst there is a heavy concentration in the east coast of the US and across Europe, you can see across the rest of the world, almost in every time zone, there are nodes running. And so again, that means if there was some natural disaster or something of that scale, the Ethereum network would still potentially be running as long as it wasn't a planet-wide disaster. I also just want to highlight the operational requirements to run a node. So the more nodes that could run, then the more diversity you might get in clients, the more geographical diversity you might get. nodes might run in places other than AWS, as we've looked at before. And to run an Ethereum node is actually not a particularly taxing hardware requirement. So you can see here on the left of the screen, I've put the requirements for an Ethereum node, and you'll see that they're pretty much, you could run that on a home computer. I've put an example on the right of another proof of stake layer 1 blockchain, and that's just not something you're going to run at home. There's a lot of cores and threads you need to run. That's a lot of RAM that you need, and so that's just another tick in the box for an Ethereum node provider. In that, if it's easier to run, you can have more nodes, you can have a wider variety of people being nodes, and that makes the network more decentralized and more robust. We can also look at the number of validators that make up a network. So theoretically, once you start getting above around 33% of the network being controlled by a single validator, you start getting to risky points where validators can try validating parts of the network incorrectly. This is something that Ethereum has taken a bit of criticism for in the past. So if you look at the pie chart in the top right, that's the distribution of validators. The grey section there is unknown, but the largest, which is an organization called Lido, it is known exactly which ones are Lido, so the percentage of the chart wouldn't be bigger than that for Lido. But Lido itself isn't actually just one validator. So Lido is a collection of validators that have ganged together for network effects. And so a lot of people have criticized Ethereum by saying, well, Lido is reaching this critical threshold. But when we look at the bar chart on the bottom left, you can see that Lido is actually lots of different independent validators here, each capped with a percentage that they can take of the total Lido stake. So that helps decentralize the network, and actually means that the number of validators that would need to gang together to cause a problem to Ethereum is actually very large, and therefore more unlikely to happen. So a final section on Ethereum's unique selling points, and probably affects institutional clients more than anyone else, is the ESG, so the environmental social governance of the network. So looking at the environmental section, Ethereum recently transitioned to a proof of stake system instead of a proof of work system. You may be familiar with proof of work systems, as it's how Bitcoin runs. Proof of stake is an economic security system rather than a hardware processing power security system. And this means that the actual computer processing requirements for the Ethereum network are far, far less than they used to be now. So you can see, if we're looking at the energy consumption per transaction, if we scaled it to represent buildings and sizes, ETH POS on the bottom is the Ethereum proof of stake network. You'll see is the size of a screw in terms of per transactions, whereas you'll need a massive building for Bitcoin. So it takes thousands and thousands of kilowatts more to execute a Bitcoin transaction than it does to execute an Ethereum transaction. That makes the network very efficient. So I think a lot of the bits that we've covered over the last few slides especially show why the Ethereum blockchain space is valued amongst people, and why people are willing to pay a premium for that block space over other blockchains. Now, there are actually other areas that make Ether as an asset an attractive purchase. I'm going to cover some of those now. So the first of these alternative narratives for Ether and its value is Ether as a form of money. To be honest, this one for me is one of the weaker alternative arguments. But you'll see this snip taken from a Fidelity report from August 2023 shows that in the eyes of the authors of the Fidelity report, Ether is a superior form of money over current fiat money. I don't tend to agree with this as a value proposition for Ether. I tend to think that if you're going to be using Ether as money, you want something a lot more stable than Ether's current price. You want to be going to the shops, and one moment something costs 1 Ether, and the next it costs 1.2, the next it costs 0.8, and so on and so forth. So I think the price of Ether is just too volatile to be used as money. But that hasn't stopped people creating stable coins on Ethereum. So that could be something that's pegged to the value of £1 or $1 or €1 or €1, and then you could transact with that on top of Ethereum. if that did become a primary use for the Ethereum network, then that would drive value to Ether, the token, because every transaction has to pay the gas fee, as we've seen before. And so therefore there would be value driven if people use stable coins as a means of payment. But I personally can't see Ether, the asset, being used as a means of payment. Another investment narrative is the store of value. So Bitcoin has a very strong store of value narrative. There will only ever be 21 million Bitcoins ever produced, and the majority of those are already produced. So there's a finite supply of something. So theoretically, if the base money system that we use, whether that be dollars, pounds, euros, etc., is inflating at a certain rate every year, if Bitcoin was to hold its purchasing power, then the value of each Bitcoin would increase to in the base currency terms, so in your dollars or pounds terms, because it has that limited supply. And so therefore Bitcoin could be used as a store of value. You can make the same argument for Ethereum, and potentially an even stronger one. So whilst Bitcoin has a 21 million cap at the top, Ethereum doesn't have a cap, but it has something slightly different. Because it has that burn mechanism in the fees that we covered earlier, you can actually have a deflationary supply when there's a lot of activity on the network. And so in my eyes, this acts as effectively as a share buyback. So the Ethereum network is generating lots of revenue. And so what does it do? It burns tokens because of that revenue. So therefore, if the market capitalization of Ethos of the Ethereum network stayed the same, the value of each Ether would have to increase because there's now fewer Ether making up the Ethereum network. This is also quite reflexive as well. So as the price of Ethereum increases, the base fees on Ethereum scale with that. Activity tends to pick up as well as people get excited when Ether picks up in value. And so you get more deflationary activity as the network becomes more popular and more valuable, which in turn starts the cycle again. So I think we could see some feedback loops in the future where activity on Ethereum increases, so the amount of Ether decreases, which pushes up the price, which makes people excited about Ether, which increases activity, which decreases the amount of Ether, which pushes up the price, etc. Another investment narrative I just want to touch on, just briefly mention, is Ether as a yield-bearing asset. So there's a couple of things to take into account. So now that Ethereum is a proof-of-stake system, you can collateralize your Ether and post it to the network and use that to help validate blocks. You then receive rewards for doing that as part of the network. Because there's a network issuance as well, there's a net positive gain in Ether by staking it. So you get a certain staking yield, and then if you take away the token inflation, you get a net yield of about 3.2% for your Ether, which means it's a positive yield-bearing asset if you were to stake your Ether. And obviously, the network issuance varies on Ethereum quite a lot. Sometimes it could be negative, which would drive up your net Ether acquisition higher. Sometimes it could be really high if there was depressed usage, which will drive your yield lower. And so I've just compared this to a couple of the other major layer ones, and you can see that the Ether actually compares favorably. So not only is Ethereum more established, has the first mover advantage, but you also get a higher yield, a higher net yield by staking Ether than you do some of the other assets. So what about price predictions, and how can we value the Ethereum network? Now I'll be the first one to say that there isn't a good way to value blockchain networks at the moment. So I've approached Ethereum looking at it almost as if it was a company which has cash flow from people buying block space from it as a mental framework. But there are a couple of different ways we can value it, which I've just prepared here. I've prepared a few graphs and charts, put some numbers to it so that you've got an idea of where I'm looking at for my price predictions. So the first way of valuing a network would be to use something called Metcalfe's law. So Metcalfe's law suggests that the more participants you have on a network, the more valuable the network is. So for example, if only 2 people in the world had a mobile phone, it wouldn't be that valuable as a network because only one phone can call the other phone. You can't do anything else with it. Whereas as soon as you get 4, 5 phones on the network, there's a much larger combination of connections that could be made across that network. And so the mobile phone network becomes more valuable. And so this is generally valued as the value of the network is equal to the number of nodes squared. So as the more people that join the network gains value exponentially. So that's one way of valuing the network. So what I've done here is I've taken the total addresses on the Ethereum network, which is this red line. I've plotted that, I've created a best fit line to that, and then I've projected it out on the right of this chart for another 2 years, which would take us towards the end of 2025. You'll see here as well that I've tried to broadly by eye fit the trend line to what I'm calling the non-bubble data of Ethereum. So you'll see there are these big spikes in price. So if we ignored those big spikes in price, we can see we've got a fairly good trend line that fits the price of Ether, ignoring those spikes. And so I think that could act as a sort of baseline fair value prediction for Ethereum over the next 2 years. And you'll see that by November 2025, it predicts would be somewhere around $3,500 US. So if we look at previous hype cycles to get an idea for what could happen if we get another hype cycle, you can see that in the last one, the price of Ether got to about 4.4 times what my sort of visually fitted Metcalfe's law line would have been. So if we do the same exercise, we project out 2 years, and then we put on that 4.4 multiplier, we get around a $15,000 Ether as a max token price towards the end of 2025. I do just want to caveat this approach. So the main caveat really is that this is using the total address count on Ethereum. So that doesn't necessarily mean the total number of users, since a user can have as many addresses as they want. It just means this is the total number of addresses that have been generated on the Ethereum network. So it isn't necessarily linked with the active daily users, etc., which some people may see therefore as a bit of an inflation of the Ethereum network. And so this trend line that I've got going up might be steeper than it should otherwise be if you took, say, daily active users instead of the total wallet addresses. Another way of trying to predict the price would be to think of it purely more as a technical chart price point of view. So when a network is really young, you see really exponential growth in the network, and at some point that growth starts to flatten off. And so that's led to some people to plot regression lines, and these are plotted logarithmically. So you can see there's a steep section at the start of the chart, and then it starts to flatten off. And if we project those out into the future, you can see if we project out to the same areas, we get a central prediction of just shy of $5,000 for Ether, and we get a bubble prediction of around just shy of $12,000. The $12,000, I've actually picked a band lower than the color band on the chart here that Ether hit in the last hype cycle. The reason I've done that is, one, just to be a little bit conservative, and two is because you can see each of these hype cycles that we've had, I say each of the last 2 hype cycles, they've slowly been compressing down, both in the maximum high and the maximum low that's been reached in the cycle. So therefore, I kind of think that pattern might continue. Some people call this the diminishing returns theory. I think it's something I broadly agree with. Another broad way of valuing the Ethereum network could be to look back at the total value that is settling as a network. So earlier in this thesis, I showed how the Ethereum network in 2021 settled more value than Visa. So if we just take the information of Visa, for example, so if we take its market cap, you can see that its market cap is approximately twice that of Ethereum. So if we therefore said that the Ethereum network has the same value as the Visa network because it's settling approximately the same amount of value, then Ethereum could be 50%, only 50% of the size that it theoretically should be. So that would put an Ethereum price well over $4,000, as opposed to it's around $2,000 at the moment. Alternatively, we can look at the revenue of the network. So Visa has around 32 billion in revenue per year. And as you can see here in my projections, the Ethereum revenue is very unpredictable compared to Visa, whereas Visa's revenue is made up of so many small transactions. There's a constant trickle of revenue and transactions coming in. whereas Ethereum goes through cycles of high demand, low demand, high demand, low demand. And so that makes pinning a valuation based on the revenue really, really difficult. You can see here by my numbers, it could be anywhere from about $25 to $5,000. So I don't think this is particularly the most useful metric, but the market cap metric maybe gives us a bit more of a firm steer that possibly Ethereum is undervalued. And finally, we could make the assumption that Ethereum is valued fairly correctly. And if we do that, then we just need to look at what the potential growth of the network is to look at potential Ether values in the future. Now, I've projected out again for 2 years a couple of different growth percentages. So that's a year-on-year growth percentage. You'll also see that I've worked out the approximate number of Ether in circulation. So I've taken the average burn rate of Ether per day, which would make Ethereum slightly deflationary, which would mean that we actually have fewer ETH in circulation by November 2025. And you'll see that puts our fair value at between about $2,500 and $4,500 in 2 years' time. Again, this indicates that Ethereum is probably undervalued, probably not far off if we get a slow network growth over the next couple of years, or we could potentially see a doubling in the fair value over the next couple of years if Ethereum continues to grow rapidly. So just to summarize those price predictions, the fair value in my eyes is probably some mix of all of these. So we're probably looking at somewhere in the sort of $3,500 to $4,500 range in 2 years' time by November 2025. That would approximately be a doubling on the current Ether price. So a 100% return in 2 years would be great. And also there's these bubble valuations. So if we do get another hype cycle, my sort of simple models project out that we could be at sort of 12 to 15,000 Ether as the top for the next hype cycle. I'm going to be selling out before we get to those bubble valuations. I'm probably going to start dollar cost averaging out once we start getting towards these fair value bands, and then I'll keep some in and sell out if we start getting a bit of a hype cycle starting. But that's roughly where I stand on my Ether investment thesis. It has evolved slightly over the last couple of years with the merge EIP 1559 being introduced. I am still actively looking at some of the other major competitors to the Ethereum network. There are a couple that catch my eye, but to be honest, Ethereum has the first mover advantage and I think is a much better asymmetrical risk bet than a lot of the other networks that are around at the moment. So thanks for watching. There are 2 more videos here that I think you'll probably enjoy. The first is my 0 to 1 million playlist, where I'm trying to build a £1 million investment portfolio. So you can watch the whole playlist up here. The second is my current portfolio video, which was the last video on my channel, and runs over what's currently in my portfolio and what the value is of that. I'll see you again soon. Thanks for watching.